As we are recording this, we also got the June non-farm payrolls, the jobs report. 57,000 payrolls added in the month of June. Much worse than expectations. What did you make of the jobs report?
It's kind of all over the place. I quoted my old colleague, John Riding, who used to work at Bear Stearns. And he said, on the one hand, you look at the May-June comparisons, but on the other hand, you see like household employment falling by 500,000. So it's really difficult to figure out which way these indicators are pointing in terms of the economy. And I think, to me, it just shows you again that you can't take a lot out of these numbers month by month. You have to look at them over 6 months or even a year to get a sense of what they mean.
Yeah, that is a good point. You do have to look. You can't just look at one data point.
Well, they adjust them too. Next month they will adjust both of those numbers.
Do you think
for
upward?
A variety of reasons.
They'll be much more positive.
You don't know. This economy is still roaring along, Julia. That's my take. My gut is this economy doesn't mind where interest rates are right now. And even if the Fed were to hike short-term rates, maybe a couple quarter point changes, I'm not sure how much this economy would slow down. So if that's, their response to higher energy prices and other inflationary forces, I don't know if it's going to be effective.
I guess, why not hike then?
Well, yeah, you can make that argument. I think Warsh is going to take his time. That's still my sense. We've talked about this before.
Yep. Do you think, do you think the labor market's still steady then when you look at the bigger picture?
Yeah, to the extent that we can rely on these statistics. I do think that in the markets I'm familiar with, you don't see a whole lot of excess supply. You have employers looking for good people on a pretty much continuous basis. And I also think that, with the move in prices, with the move upwards in housing costs and things like that, the natural tendency of Americans is to work harder to make it work. That's the remarkable thing about this economy. So I'm not sure how much impact the Fed could have one way or another, to be honest with you.
Yeah. And it's a good point about Americans and working hard too. Precious metals, there was a note out from Goldman Sachs this week that we could see 4,900 for gold. I know you've been favoring gold or adding to your precious metals.
No, people have been writing about me. It's almost embarrassing.
What are they saying?
No.
Up to this point, we've heard a compelling case for why gold and silver remain important despite recent price swings. The key argument isn't just about today's market, it's about long-term supply, growing global demand, and how central banks continue increasing their exposure to precious metals while many individual investors remain on the sidelines. If you're interested in honest insights on gold, silver, inflation, and the global economy, make sure to subscribe, hit the like button, and share your opinion in the comments. Do you believe gold and silver will outperform traditional investments over the next few years?
This venerable analyst, Chris Whalen, is advocating gold and silver. I think the Goldman piece is really interesting. I think people should look at that article because what they're saying is the same thing you and I have been saying for almost a year, which is that there is a structural shortage of silver and gold. Gold is more of a monetary play. Silver is a commercial play. So if you see the price of silver fall the way it has in the second quarter of this year, I think it's almost behooves you to go buy some because it's not like we're going to go create a lot more silver in the near term. There's only so much productive capacity. We have gotten rid of an awful lot of silver with this war. It just vaporizes, right? When we use these munitions and high-tech weapons. And then meanwhile, the demand for technology across the board, I don't care what you're talking about, is growing. So the Chinese have continued to be aggressive buyers of silver, both in the futures and the spot market. I haven't changed my view. I think you've got to have at least a portion of silver and gold in your overall portfolio. It's a hedge against the dollar. It's a hedge against inflation, but it's also just recognizing that there's only so much of this substance on the planet that you can actually access in an efficient fashion.
I think sometimes, people who are really into gold, they get kind of thrown into the camp of like they're a bit like doomsdayers, or it's like end of the world and I need like a bunker in my gold or whatever. But
they had to wander through the desert for years. The price of both silver and gold did not move a whole lot if you go back and look at the data. And it was only when I think people started to focus on the fiscal situation in the U.S. and other factors, and obviously the dollar, that people began to wonder, gee, what do I do to protect myself if the dollar, for example, starts to weaken dramatically? How do I protect myself long term if I want to preserve value? Real estate's always been the first call, very easy to get into. But precious metals, I think, more and more is gaining ground in that respect, because the global central banks, other countries, are trying to diversify away from dollars into things like gold. That's a pretty powerful force. And that's why, last year we wrote a piece about this being an asymmetrical trade. That's something I talked to our friend Jim Rickards about. And it hasn't changed. But you're right. I mean, the gold bugs have always been kind of put into that wackadoodle bucket, but not anymore. I think there's enough financial professionals out there talking about gold and silver that it's gaining real currency.
I agree with you on that. By the way, as you were just talking, I was just taking a quick little peek. It's our country's birthday. Our U.S. national debt is at $39.35 trillion.
Well, at some point, we're going to have to deal with this. The politics are not very helpful, though. I think the Democratic Party is going to get torn in half. Half of them are going to become "quote unquote" socialists, and the other half are going to have to become Republicans.
Oh man, what do you make of that? Like the kind of rise of the Democratic Socialist candidates. We've seen this in New York City. There's one in Colorado recently. Yeah,
they have nothing to say. I mean, people like AOC can't even form complete sentences. These are not people who have any solutions. And for the same reason the Fed can't fight inflation, they can't do anything about it either. Mayor Mondami in New York City just froze rent. That's only going to reduce the number of apartments that are available. So we'll build condominiums for rich people, but we won't build affordable housing in New York because you can't. You would have to think about it. It costs you over $4,000 per square foot to acquire property and build in New York City. How are we going to make that affordable?
That's just...
Only rich people could live in a building like that, Julia. You and I can't afford to live in a building.
I couldn't do that. I wonder, Chris, a lot of the people who are going to be impacted by that.
This discussion also highlights a much bigger issue than precious metals alone: rising government debt, persistent inflation, and changing investor behavior are all connected. Understanding these broader macroeconomic trends can often be more valuable than reacting to short-term market headlines.
Rent freezing. They're probably mom and pop landlords too, aren't they?
Oh yeah, it's going to force them out. And the older buildings that tend to be owned by local business people, investors, that sort of thing, they're the ones that are going to get killed, because those are the buildings that need maintenance and upkeep. And when you take away their ability to recapture costs when they take care of the property, it's just a no-win situation. There's 1 million rent-stabilized apartments in New York City. And what Mayor Mondami is essentially going to do is turn New York City into a slum. Yeah. It's not that rich people won't live well, they will, but you're going to have people of modest means who really can't afford to live in that city in the first place, but they can't afford to leave. That's the irony. Think about this, Julia. You know New York. How much money do you think you have to make every year just to live in New York City in a reasonable way?
Oh, a lot. And then you're not even living like a
lot more than the federal poverty level, right?
Yes, and definitely you're not going to be living like a king. Mike Green had the piece, and what was, I think he said like the level was like 120,000. I can't remember. Matt probably knows, but it was like 120,000 a year or whatever. And
Right.
you're not rolling in the big bucks in New York City. Like I don't even know if you could do that in New York City, but like you're scraping by.
Barely. And imagine if you have a family. Imagine if you have children. I've always said we should be relocating lower income families outside of New York City, because even Westchester County, which is an affluent community, the cost is half.
Mm-hmm. Yeah, the only reason I could live in New York was I lived with my sister, and I got help from my dad for rent when I was in my 20s, and then I moved in with my now husband. But it's I mean, they weren't paying us a lot of money as journalists back then, but yeah. That's crazy. I actually looked at my old apartment just to see like what is the price these days, and I was like, oh my gosh, I could not do that.
Oh my gosh,
no way. All right, Chris. You also wrote about the Trump crypto thing, and that's in your headline. Okay, talk to me about the Trump crypto.
Well, the president he's done very well on his various crypto ventures. Most of the investors in those ventures have lost a lot of money. This is kind of typical of Donald Trump. We have a link in the blog to David Enrich's book about Deutsche Bank that we reviewed years ago in the Institutional Risk Analyst. That is just a wonderful tale about Donald Trump and his various investments. It's a great book. I recommend everybody go out and read it.
All right. Well, speaking of books, we have to get into the viewer mail. And I want to thank today's show's sponsor, and that is the new book, The Entropy Trap. It is a new book by econophysicist Mickey Maney. And Chris, I first heard about this book because you did an interview with the author in the Institutional Risk Analyst very recently. And so after you did that interview, I picked up a copy. And based on a lot of the conversations that we have on this show, I think that our viewers would love reading this one. And I know you did too.
Oh, yeah. Now, Mickey is a very smart guy, worked on Wall Street as a banker, worked as a businessman in Asia. He has done a lot of deep thinking about the intersection between science and finance. And what he's essentially showing us is that many of the things that we don't necessarily recognize in the day-to-day life, if you step back a bit and look at things like trends and currencies.
One important lesson from this conversation is that successful investing isn't about predicting every market move. It's about recognizing long-term trends, managing risk, and staying diversified. Whether you're following gold, real estate, or financial markets, patience and discipline often prove more valuable than chasing the latest headlines.
Trends in markets, it's really quite instructive. I would encourage our viewers to take a look at the interview we did, and I think you're going to probably put a link. But it's a great book, and I applaud him for doing this work, because it forces you to take a longer view of not just the economy, but society and how things change. The whole point of entropy, Julia, is that you go from a period of stability to a period of instability. It's actually a scientific term that comes from the laws of thermodynamics. And how does Chris know about this? Because I used to cover the semiconductor sector years ago.
Yeah, you did.
And, I know. It's like going to a science project every day. It was great. But I really recommend this book. It's a lot of fun.
I love that. And I know our viewers love reading and picking up books. So again, if any of you all are interested in macroeconomics, investing, and just understanding the forces shaping today's world, you can go pick up a copy of The Entropy Trap. I'm going to link it in the show notes for everyone. And Chris, you found it to be a worthwhile read. We're always looking for something to read over the summer. So I hope you all enjoyed that one. And now let's get to the viewer questions. We have a bunch this week. All right, Chris. First question comes from Steve. Question for Chris on PennyMac. Is he concerned about their leverage?
I'm not so concerned about PennyMac's leverage because it changes. When mortgage companies have to hedge interest rates, they tend to take on more leverage. When interest rates are falling, volatility is less, they have less leverage. What I worry about with PennyMac, though, is the way they run their business, the way they do actually hedge their interest rate risk, because oftentimes they spend too much money on it. You may recall I'm good friends with Stan Middleman at Freedom. He doesn't hedge a lot of his risk on his mortgage servicing book at all. He goes out and makes more loans. It's a very different approach, whereas public companies like PennyMac, because they want to, I think, preserve or protect the fragile sensibilities of institutional investors, they spend a lot of money trying to hedge and reduce the swings in income and earnings that results from the business. It's an interest rate sensitive business. So I like PennyMac. They're one of the market leaders, but frankly, I'm much more keen on players like Rocket, who I've worked with for years. I'm an advisor to them. I think they get it right. I think Freedom gets it right, the way they run their business, and there are a number of others. And of course, we talk about Annaly a lot. That's a mortgage REIT that just goes out and buys mortgage-backed securities. Again, no, they have to hedge the interest rate risk, and they do so very efficiently. So when I talk about a mortgage company, I'm not so much worried about the leverage if they're doing good things with it, if they're going out and making money with it, right? Because it is a leverage business. Most mortgage companies will have at least 5 times debt versus equity in terms of leverage. So I wouldn't worry about that particularly.